Are you feeling stressed? This week, we're talking to a financial planner who's got some research from FP Canada talking about the stresses Canadians are facing. We'll see where you come in on all of this.
This is Make Better Wealth Decisions, a podcast about financial blind spots, decision-making, and how the reality of higher rates, global tensions, and tariff instability impact your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto.
My guest this week is Sarah McCullough. She is a CFP, a CFDS, and a CDFA. She's a fee-only and advice-only financial planner. Let's see if we can walk you through what those various designations all mean. CFP, as you probably know, is a certified financial planner, but she is also a chartered financial divorce specialist and a certified divorce financial analyst. She's been giving advice for 23 years in total, and for the past 10 years, she's been working in the advice-only channel. So her goal is to help clients to have the technical information they need combined with their personal situation so that they can have the confidence to proceed, knowing what their priorities are and what their goals are with confidence. Sarah, how are you today?
I'm well, John. How are you?
I'm great, thanks. We're going to talk about stress today.
Super.
That's the thing that a lot of people are feeling in 2026 because of the world around them, and they're feeling it because of a whole bunch of reasons, the economy and war and AI and you name it.
Yes.
But you and I are both involved with an organization called FP Canada, and they're the people that confer the CFP mark, and they just recently released a new study called the 2026 FP Canada Financial Stress Index.
Yes.
And I wanted to talk to you about that. Okay. Maybe I'll open the floor by saying, please tell us, what is the 2026 Financial Stress Index?
This is really a survey that FP Canada undertakes. They've been running it for a number of years now. And the survey's goal is to get a sense of where are Canadians in relation to their money? How do they feel about things? What's bothering us? What's going well? So it's really FP Canada's attempt to get a temperature check on where Canadians are. That does a number of things. It can help advisors just be more aware of maybe some sensitive points for clients when we're going into meetings. It also helps Canadians, I think, when they read the results to see that they're not the only ones worried about high grocery prices. One of the common conversations in my client meetings is, am I the only one who feels this way? Am I the only one who can't figure this out? Mm-hmm. And I think it can be really helpful to understand that this isn't just something that's bothering you or worrying you.
Right. So there's a certain amount of safety in numbers, and realizing that you're not too far off. So money is usually the number one source of stress. And I'm just looking at the results overall. The numbers have consistently, for the past number of years, been anywhere from the high 30s to the mid 40s percentages in terms of the number one stressor in people's life. I don't know that that's a big surprise, but I'm wondering if you have any comments with regard to why money remains such a major concern for people.
It's really, I think, a number of things. We're often very unclear on our own situation, so our own kind of day-to-day. There's a lot when we talk about how to fully clarify how much money is coming in, how much is going out, where is it going, why are we in the current state that we're in. That actually takes a lot of work. That is an enormous conversation. So there's that piece of it, is we don't have a lot of clarity on our own situation often. And then when you layer on top all of the things that we can't directly control. So all of the tax changes, geopolitical instability, right? All of those other things, when that gets layered onto something that we're already unclear on, that's a lot of stress. The other thing is, when we say money, we don't mean money. We mean, how do I support my family? How do I keep myself independent and stable? How do I not be a burden on my kids as I get older? That's what we mean. So that's what we're talking about. We're not talking about just money, dollars and cents math exercise. This represents how we can do what we want to do as adults in this world.
So it's funny because there are a lot of things that are part and parcel with the world in 2026 that can be stressors. Certainly AI is becoming more of a stress. The geopolitical uncertainty, which you mentioned a moment ago, the tariffs that are part of that uncertainty, but also a war that's now going on. There are a lot of things that are going on that probably weren't even captured in the 2026 research because some of them are
Correct.
actually things that have come out since the research came out. But one thing that I noticed that is not mentioned, and I find this maybe encouraging, is market performance. I don't really hear a lot of people saying they're stressed that markets are not doing well. So I think most people, if they are investing as part of their overall financial plan, are not worried about their investment performance. I'm wondering if you have any comments on that one way or the other.
I do. I think you're right, John. And I think that markets have done very, very well, particularly in the last 5 years. We are actually statistically far above average market performance. I think it might show up in the survey that we do immediately after the next market decline, because part of what's happened is our expectations have shifted.
Right.
And we think these are now normal returns.
So that's exactly going to lead into my next question, which is, as you know, FP Canada every year at the end of April puts out annual assumptions guidelines.
Yes.
And those assumptions guidelines have been, for the past number of years, have been saying you should expect long-term returns for Canadian and US stocks to be in the neighborhood of 6.5% or 7%. And as you quite properly pointed out, they've been way, way above that for many years already. And if in fact 6.5% or 7% is a reasonable, let's say 6.5% is reasonable, and you've been getting, say, 13 for the past 5 years, that would be another way of saying that if you got 0 for the next 5 years, you shouldn't be particularly surprised.
Correct.
And
we would be.
But I think most investors would be, and they're saying, "Oh yeah, I'm happy with my returns. They're doing better than I expect." So maybe they recognize that they've actually had a particularly good run. But when you talk to people and about the stresses they're experiencing and the planning they're doing in your day job, do you ever say, "Hey, Mr. Jones, maybe you should take some risk off the table. You know, you've done very well. And we should, if you don't want to be stressed, but the best way to avoid stress is to preemptively take the stress off the table before things start going haywire." How many people are, in your experience, how many people in Canada are doing proactive stress management in that kind of way?
I think it really depends on the advice that they're getting.
Uh-huh.
So in my practice, I do use the FP Canada rate of return guidelines,
Right.
which puts a balanced portfolio in the planning software that I use, puts it around 4.3% rate of return. So I get an awful lot of pushback from clients around that's really low. That seems really low. I have investment advisors as clients. And so I have one in particular that every time I show him his projection and we look at the rate of return, he says, "Sarah, I would fire me if that's what I got." And I say, "I understand. I need you to know, though, the effect over the long term of this variation in returns." And that's how we get to, the FP Canada recommended rates of return. But as a client, that's also the experience we have. We don't get the average return, we get the annualized rate of return. So it's really important that we've calibrated those expectations correctly, because that's, again, going to affect, if we think that our current portfolio is going to keep getting 13% every year, we might think we don't need to save anymore for retirement, right? So we mentally check off that box and we redirect our savings to something else. So when markets have a bad year, because what goes up must come down, we do return to averages. As you pointed out, to get back to average right now is going to take a heck of a decline. And then again, as clients, when we come back to normal, we're going to be short.
Right.
We're going to be short because we've redirected that money. So I do talk to clients a lot about why I'm using the rate of return that I'm using in their plan. Depending on the situation, I will run a Monte Carlo analysis for them. So that gives them more of a real market year-to-year variation returns. So we can see, what if you get a great series of returns? What if you get a not great series of returns? What if you just get an average series of returns? So again, clients are able to make confident decisions and they're able to approach their investment returns in a way that doesn't knock them off course when something normal, like a negative year, happens.
So that's all part and parcel with making better wealth decisions, is the knowing that things can be good and things can be not so good, and perhaps recognizing, at least implicitly, that things have been pretty good for quite a while now. One of the things that I wanted to mention is that people, I've mentioned this before in this podcast, but I think it bears repeating, that those guidelines, which will say generate a balanced portfolio at 4.3, part of why that number is lower is because the guidelines mandate that the planner reduce the expected rate of return by the cost of the product and the cost of the advice. So even if you're using low cost products that cost 1.25%, and even if your advice costs, if you're an advisor, maybe 1% of assets, that means you might have gotten, say, 5.5% before those costs come off, but that's another 1.25% that comes off, leaving you with 4.25%. And then people say, well, that's too low. Well, that's because if you do it properly, you need to take into account those are fees that are going to be paid by you as the investor. You're not going to get that. That's one of the costs of actually having these investments. And so your portfolio will not grow as quickly as you otherwise might have grown because nothing is free. Okay, I digress. But I wanted to say that because I thought it was an important thing to add.
Yeah.
There are a number of sources of stress, and looking at the research, what are the causes of stress? And the numbers here are the things that jump out at me is grocery prices, 64%, rent or mortgage payments, 51%, gas prices, 32%. That's before gas prices went up by 25% in the past 3 weeks. I'm wondering if you could, these are things that are just very banal, ordinary, everyday expenses that people have. So it's not like they're stressed out about, putting their kid through Harvard. It's about just everyday expenses. Do you think Canadians are particularly stressed, maybe as compared to other people? And how would you portray the level of stress that Canadians are facing as they go about planning their financial future?
I think the level of stress is pretty high across the board. And, when you say we're worried, the things that come out in that survey are the very kind of run of the mill. We're always going to have these things. We're always going to have food costs, housing costs. The reason we worry about them so much is because we know that it's pulling our resources away from what if our kid does want to go to Harvard, right? So again, that is connected in there. We just don't say it. It's easier to say, and again, the questions in the survey are focused on, again, our kind of shared experiences. So the survey questions definitely focus on shared experiences so we can get kind of that group temperature. But again, the reason we're worried when those costs go up is because we all have that list of things that are very particular to us. I want to do this for my kids. I want to do this with my partner. I want to do this for my extended family, for my community. And if we can't even get over the grocery and housing costs easily, we think, I'm never going to get to these though. And so that's why sometimes we have such a big reaction to those kind of costs that are just existing. Those are just our existing costs.
One of the things that strikes me about the research, and I find it assuring, is that it shows consistently that people who are getting advice are more confident about their financial future than those that are doing things on their own.
Yes.
And you and I both give advice in varying capacities, so we both feel good about ourselves and doing what we do. But maybe you can offer some thoughts about the value of advice and maybe how that pertains to making better wealth decisions.
Okay. And so I thought about this. I had a chance to think about this over the weekend after you sent the email. And I think what might be really helpful here, because a lot of Canadians also aren't familiar with advice-only financial planning. So often our financial planning comes to us in connection to an investment portfolio or to a product sale like life insurance. And that planning is also valuable, but it can be very different from the advice-only planning that some clients experience. And so why does the survey keep showing this result? Because you're right, that's been very consistent across the years that FP has been doing this. Why is it that clients that have advice have less stress? And if I can give you a road trip analogy for this one, if we are taking a road trip somewhere and the route is familiar, when there's a snowstorm, it's still stressful. That storm itself is stressful, but we also still have some idea of where are we, how can we orient ourselves. We've got some familiarity, even with this added stress. If we are on a road trip in a place that we are unfamiliar with and there's a snowstorm, now we've got nothing. Now we've got no way to orient. We still have to make decisions, but we can't even calibrate what's a good decision, what's a bad decision. So when you have a financial plan, when you have an advisor to go to, you at least have that familiar terrain to your advantage. We can't control the snowstorm. In either scenario, snowstorms happen when they happen, right? So in our case, for our conversation, inflation happens when it happens. None of us had any direct say over the war, right? Those kinds of things, AI, we don't control that directly. What we can control is how familiar are we with our own terrain, and that helps us make more confident decisions because we just know more about the situation in general.
So I wanted to take this opportunity to dovetail something that I've been doing for some time in what you do in your day job, because you've got a specialization in working with divorce and people going through it. So I've written a few books, and my most recent book is talking about optimism bias. And I want to tell you a story about optimism bias as it pertains to divorce, because I think it's really useful. So one of the things that you will find is if you ask people in general, the public, what is the divorce rate in Canada or the US or in Western Europe? And people know that it's approaching 50%. It's usually between 40 and 50%, depending on where you go. And most people know that that's the approximation of what you should expect. But if you ask newlyweds on their wedding day, what are the odds that you will divorce? They will all say, well, the odds are zero.
Yeah.
So there's a story there about ignoring base rates and what have you, but it's also a very telling story about optimism bias. Optimism bias is where you understand that bad things, in fact, happen all the time, but you nonetheless believe that you're immune and they're not going to happen to you personally.
Right.
That's optimism bias. Because you have some specialization in divorce, and because it is a real stress in people's lives, what would you say are the things that people think about as they try to navigate? Should they pull the plug on the marriage, or maybe some people stay because the financial pain of divorcing would be greater than the emotional pain of staying in the marriage, and you've got to consider the kids and whatnot.
Right.
What are your thoughts about all that?
You're right. It is an interesting human contradiction, I think, that we often do know these stats going into a relationship, and we know that there is a chance that ours wouldn't make it, and we do it anyway. And sometimes we do it more than once. And I don't think that's the wrong decision. I think in a lot of our financial decisions, there isn't going to be full certainty. There's never going to be full certainty as much as we try to nail down everything, because some days we like that. And there are some personality types that really operate better with more certainty. And none of us know. There was an article, I think it was the Globe and Mail within the last couple of weeks, about how many of us stopped working earlier than we planned. So again, they kind of asked people how long do you think you're going to work? They gave a number, and then they went back to check on, did that happen? 85% of these participants stopped working earlier than they planned for a variety of reasons. Does that mean we shouldn't plan? No, right? So does this mean we shouldn't get married? No, because if that's what you want, then do that. And I often talk to clients about what if the relationship ended. The other reality that I think is important when we are talking about relationships ending, I think it's important to be mindful of all relationships end. It's either death or divorce. If you are in a relationship, one of you is likely to die before the other one. One of you will experience an end, or both of you will experience an end. And so I think in there, it's important to look at what happens if the relationship ends. My client base is statistically quite young. So I often deal with clients who are going into their first marriages or cohabitation situations. And they're often coming in with assets, with money. And so I have a lot of conversations about, here's what a marriage contract or cohabitation agreement is. This is how it would function for you. Talk about whether that's important for you. So we do actually talk about, at that inflection point and decision point, we do talk about, what if this didn't survive? What if it didn't? So I think we do a lot of things that have high risk of failure and high reward, right? So if we think back about to your earlier comment in the stock market, what are we drawn to? We're drawn to those stocks that went up 80% last year or could go up 80%. What did you just ask me about? The draw of, but what if my relationship made it like all the way? What if mine ended through death, not through separation? So I think that high risk, high reward, well, we don't often think of marriage in those terms. I think it's the same.
It is in many ways the most consequential financial decision you will make in your life,
Yes.
and that is who your life partner will be.
Yes.
All right, this has been a fascinating discussion, but we're running out. I have to wrap this up. Sarah, it's been a pleasure. I always like to end with my favorite question at the end is, podcast is called Make Better Wealth Decisions. If it was up to you, what advice would you give listeners to help them make better wealth decisions?
I would like listeners to ask questions before they make a decision. I think when we have more information, we make better decisions, and we often kind of go through with partial information and then make a decision that can really kind of change our path in ways that we're not aware of. And so I think when they're in a conversation or about, a financial decision, whether it's around the portfolio, whether it's around a mortgage amount or something like that, if they have somebody kind of selling them something or advising them to do it, I would like them to say, can you explain how that helps me meet my goals? So if I do this thing that you are recommending, how does that help me meet my goals? And I think what that does is lets them know, did the advisor listen to their goals? Can the advisor repeat back to them? If you do this, your goal percentage success rate changes like this. So I think I would like people to have more information, ask more questions before they say yes or no.
Wonderful. Sarah, thank you for your time today. It's been a real pleasure. I want to wish you all the best going forward.
Thanks so much, John.
This podcast is not to be construed as offering specific investment advice. Please consult a qualified advisor before acting. My books, Stand Up to the Financial Services Industry and Bullshift, are available online. If you'd like to meet to discuss how the topics in this podcast affect you directly, please visit my website.